Hello and welcome back to FT.com. Well, the turmoil on global markets continues, and the catalyst for that turmoil lay in China. There are many other problems going on, but the trigger for the turmoil was certainly events in the Chinese economy. Now, should we really be that worried? Well, Martin Wolf, our chief economic commentator, has written a column on this today, and he argues in almost Donald Trump-like language that the problem in China could be huge. He's with me now to discuss this. Martin, what is the history of previous countries that have enjoyed growth rates like this, and what is the risk of a discontinuity?
Well, first I should say I don't consider myself very like Donald Trump.
Neither do I.
And I'm sure he would agree on that.
Yeah.
No, the basic point, in the starting point in this is that China's performance has been incredible. There are very few countries that have managed this, but history shows that most developing countries don't sustain this. In fact, lots of them have had very serious crises after quite long periods of success, and then a very different performance emerges. There are a few exceptions. The most obvious is South Korea, which has had very fast growth really for 5 or 6 decades. But even there, they had a big crisis. And the big crisis is associated with financial excess and a big adjustment to investment as the growth engine changes its nature. And I argue in my column that China is in a very similar position now, and a discontinuity in growth is certainly plausible. I'm not saying it's likely, but it's certainly plausible.
Now, what would the drivers of this discontinuity be? We can, as I think we can illustrate, China is very dependent on investment for its growth. How do you get from where we are now to where China wants to be without something ugly in between?
Well, the fundamental problem is that in order to sustain growth of demand and also driving all the supply, China has raised its investment rate to something close to half of GDP, just a little short, which is far higher than it was in China 15 years ago. And meanwhile, the economy is slowing, so the ratio of capital to output is exploding upwards, and the returns on capital are falling. And this is not an environment in which you can sustain lots of credit growth to investment, because it's not going to pay it back.
Right.
So the natural development is for investment to be cut. If you've got an economy growing at 6, maybe 7% a year, you just can't invest 45% of GDP. If the investment cut is relatively quick, and it could very easily sort of accelerate in this situation, you could take out an enormous chunk of demand, perhaps even 10 or 12% of GDP of demand in a couple, 2 or 3 years, and that would put China very close to a recession.
Now, the people I talk to in markets have this very cozy phraseology where they talk about the choices for China being between a soft and a hard landing. If we're talking about that kind of a hit to demand in that kind of space of time, that's worse than a hard landing. It sounds to me that's more like a crash. How much do you gauge the risk that that happens?
Well, relative to the assumption of 7% growth, this would feel like a crash. There would still be growth.
Yes.
But
at the margin is where markets and the economy...
It would feel like a crash. Now, the big problem is, and that's what I addressed towards the end of this, is the Chinese government would want to respond to this in a way that kept demand going without reigniting the credit growth. Right. Because if they do that, they might well postpone the shock now, but they could have an even bigger one a few years down the road, and they know that. And the question is, are they able and will they be effective in acting sufficiently rapidly to sustain demand in other ways while this adjustment in investment, which I think is necessary and inevitable, occurs in the context of a rapidly reforming economy in which everything starts to look very different. And this is a balancing act which many countries have faced in the past, including some with enormously high reputations for superb management, and have actually not succeeded in delivering upon.
Now, so far, most of the measures they've taken through this crisis period, or crisis at least in the markets, if not in the economy, have involved easing credit, fiddling with cutting rates, fiddling with reserve requirement ratios.
Yes.
Isn't that rather a worrying signal as to whether they're going to be able to manage this transition in the way that you're discussing?
The thing that has worried me is twofold. First, they don't really look, for the first time, I think, as though they're really in command of what they're doing. It looks a mess. They've spent $200 billion odd on the markets, apparently, and they've used up $300 billion of reserves, and they don't have much to show for it. So there's a question of, are they really in command? And do the people in China have confidence in them anymore? I don't know, but this is a big question. But the other side of it, yes, we know that for China, the easiest ways to generate demand in the short run is to throw money at investment and probably to weaken the exchange rate. The latter will create a very big global shock, very important global shock, and the former risks just continuing with the waste, continuing with the investment in things that nobody really needs, and just postponing the crisis to something even bigger later on. So at the moment, what's going on does not, I'm afraid, fill me with great confidence.
And for now, many viewers will obviously want some kind of a read-through for what this means for the markets in the next few days and weeks. Ultimately, it means that you should not expect the volatility to end anytime soon. While there are issues as profound or even huge as we have been discussing afflicting the world's second biggest economy, it's going to be very hard to resume any upward trend anytime soon.